2025, average daily earnings for a Panamax cargo ship came in at approximately $13,361 per day. That sounds substantial, until you know the daily operating cost. Drewry's benchmark for average daily vessel operating costs sits at $7,474, and 2023 through 2025 reviews show continued upward pressure from crew, insurance, and repairs. The margin between $13,361 in revenue and $7,474 in daily operating cost is $5,887 on a vessel that cost $30 million to purchase. That margin is the entire story of cargo ship economics, and it is the number that collapses first when the freight market moves. Here is what this actually costs. The segment we are analyzing is the Panamax dry bulk carrier, 60,000 to 80,000 deadweight tons, the workhorse of global commodity trade. A new Panamax in 2026 costs $35 million to $45 million. A 10-year-old second-hand vessel costs $18 million to $28 million. The purchase price is not the entry cost. A second-hand vessel triggers a mandatory special survey from a classification society. Used ship refits run $15 million to $35 million in scope. A vessel in average condition generates survey findings costing $1 million to $4 million in rectification before the class certificate is restored. Without the certificate, the ship cannot be insured. Without insurance, it cannot enter most ports. Flag state registration, Marshall Islands, Liberia, or Panama for most commercial vessels, costs $15,000 to $50,000 initially and $8,000 to $20,000 annually. P&I Club membership, protection and indemnity insurance, covering crew injury, third-party liability, and pollution, is mandatory for any commercial vessel and costs $150,000 to $300,000 annually. Hull and machinery insurance at 0.4% to 0.8% of insured value adds $100,000 to $200,000. Financing a $25 million vessel at 65% loan to value produces a $16.25 million loan. At 7% to 8.5% over 10 years, annual debt service runs $2.2 million to $2.5 million, payable whether the ship is trading, waiting for cargo, or in dry dock. Total first-year outlay, approximately $27.2 million before a single ton of cargo is loaded. Crew. A Panamax, with 22 crew under Philippine or Indian crewing arrangements, costs $1.2 million to $1.8 million annually. This includes officer and rating salaries, crew insurance, repatriation flights every 6 to 9 months, medical examinations, and certification. The captain earns $8,000 to $12,000 per month. The chief engineer earns $7,000 to $10,000. Minimums are enforced by the Maritime Labor Convention 2006, inspectable at every port worldwide. Maintenance and repairs. Routine maintenance, lubrication, engine servicing, deck equipment, paint, hull cleaning, costs $400,000 to $700,000 annually. A main engine failure costs $500,000 to $2 million in parts and labor before the vessel returns to service. Dry docking. Classification societies require full dry docking every 5 years. Cost: $1.5 million to $3.5 million plus 15 to 25 days off hire. At $13,000 per day, 20 days off hire is $260,000 in lost revenue on top of dry dock expenditure. Annualized over 5 years, $300,000 to $700,000 per year. Management fees. Third-party ship management. V Group, Bernhard Schulte, Columbia Ship Management, costs $8,000 to $12,000 per month. Annual total, $96,000 to $144,000. Insurance total, combined hull and P&I, $250,000 to $500,000 annually. Total annual OPEX, approximately $3,125,000. Daily OPEX, $8,562. This is before a single voyage departs. Voyage costs. Fuel represents 50% to 70% of voyage cost. A Panamax burning 30 tons per day at $600 per ton spends $18,000 per day on fuel. A 30-day voyage burns 900 tons, $540,000 in bunker cost alone. Port costs at both ends, $80,000 to $150,000. Panama Canal transit where applicable, $150,000. Total all-in cost per 30-day Panamax voyage, $900,000 to $1,300,000. Cargo ship revenue is set by one variable, the charter rate, determined daily by the freight market. The owner has no pricing power. They accept the market rate or weighted anchor, accruing costs without income. As of March 2026, Panamax rates averaged approximately $17,000 per day. In 2025, average reported earnings came in at $13,361 per day for the full year. At $15,000 per day across 340 operating days, accounting for 25 days of dry docking, port waiting, and off-hire. Gross charter revenue, $5,100,000. Subtract annual OPEX of $3,125,000, surplus of $1,975,000. Subtract annualized voyage costs of $1,400,000. Net surplus before debt service of $575,000. Subtract annual debt service of $2,350,000. Net income negative $1,775,000. At $15,000 per day, above recent annual averages, a leveraged Panamax loses $1,775 million per year. Break-even requires sustained charter rates above $20,500 per day. In 2025, the average was $13,361. An unleveraged owner earns $575,000 net annually on a $22 million investment. That is a 2.6% return before the next dry dock event or main engine failure. The 2.6% return is the good scenario. It assumes average charter rates, no mechanical failures, and a cooperative freight market. The variable that has destroyed more cargo ship owners than any mechanical fault is the charter rate itself, and its history of collapsing faster than any fixed cost can be reduced. The Baltic Dry Index, compiled by the Baltic Exchange from broker assessments across 26 shipping routes, is the most volatile commodity benchmark in global financial markets. More volatile than oil, more volatile than metals. The BDI reached an all-time high of 11,793 points on May 20, 2008. It then fell to 684, just 5.8% of its high, its lowest level since April 1986. A 94% decline in the benchmark that determines daily revenue for every dry bulk ship owner on Earth, in less than 6 months. A Panamax owner who committed to purchase and financing in early 2008 was collecting $80,000 to $100,000 per day at the peak. By late 2008, the same vessel earned $3,000 to $5,000 per day. Operating costs did not move. Crew still earned the same wages. Insurance still billed quarterly. The bank expected monthly debt service. Revenue had collapsed 95%. Cost had not. Dry freight markets remained under pressure from 2012 through 2016, despite seasonal recoveries. Owners who financed vessels against peak rates spent years in restructuring, distressed sales, and bankruptcy. The Baltic Dry Index did not recover to anything near its 2008 level for over a decade. The BDI collapse defined the structural fragility of dry bulk economics. The event that made that fragility visible to the entire global supply chain, simultaneously, at scale, involved the world's 7th largest container carrier. Hanjin Shipping filed for bankruptcy protection on August 31, 2016, described as by far the largest container shipping bankruptcy in history. Hanjin operated 98 vessels at peak. It was a founding member of the CK Hay Shipping Alliance, alongside COSCO, Yangming, and Evergreen. It was a South Korean national flag carrier. By every external measure, it was a survivor. The mechanism of its collapse. Hanjin had signed multi-year time charter contracts to secure vessel capacity at rates that were viable when freight rates were higher. When spot freight rates fell, Hanjin was still obligated to pay contracted charter hire to vessel owners. The gap between what Hanjin received from its customers and what it paid to chartered-in vessels could not be closed. In the quarter leading to bankruptcy, 11 of 12 shipping companies that published results reported heavy losses. Freight rates had been under pressure from slow global trade and a surge in capacity from new megaships. When Hanjin filed, its vessels were denied entry at ports worldwide. Port operators refused service without payment guarantees. $14 billion in cargo was stranded at sea on vessels that could not berth. Importers and exporters had no recourse. This was not operational failure. This was industry structure, a fixed-cost capital business, operating in a market where revenue is set by forces entirely outside management control. The cost that never appears in shipping investment presentations is off-hire. Revenue lost when the vessel earns nothing. A cargo ship earns only when employed under charter. It earns nothing waiting at anchor for cargo, during port congestion delays, during dry dock, during mechanical failures. OPEX continues throughout. The industry term, off-hire, obscures the financial reality. Costs run continuously. Revenue stops. Port congestion has become a material source of off-hire. At major commodity export terminals, Brazilian iron ore ports, Australian coal terminals, vessels routinely wait 7 to 14 days before berthing. At $8,562 per day in OPEX, a 14-day wait costs $119,868 in operating cost against zero revenue. Here is what a profitable-looking voyage becomes once off-hire is applied. A Panamax is chartered for 35 days at $16,000 per day. Gross revenue, $560,000. OPEX allocation, $299,670. Fuel and port costs, $620,000. Voyage loss before off-hire, $359,670. Add 8 days of port waiting at $8,562. $68,496. Total voyage loss, $428,166. The voyage that appeared profitable at the charter rate was loss-making at the all-in cost level. Off-hire converted a marginal situation into a cash-burning one. There is another cost growing faster than any other line item, not from crew, not from fuel, not from mechanical wear. It arrives from a regulatory body with enforcement authority over every vessel entering the waters of its 27 member states. The EU emissions trading system became fully applicable to maritime shipping on January 1, 2024. Cargo ships above 5,000 gross tons, calling at EU ports, must surrender carbon allowances for all CO2 emitted on intra-EU voyages and 50% of CO2 on voyages between EU and non-EU ports. EU carbon allowances traded between €45 and €75 per ton in 2025 and 2026. A Panamax burning 30 tons of fuel per day produces approximately 93.6 tons of CO2 daily. On a 30-day voyage with 50% ETS exposure, 1,404 tons subject to surrender. At €60 per allowance, €84, approximately $91,000 per voyage. 6 such voyages annually, $546,000 in ETS compliance cost, that appeared in no financial model written before 2022. The penalty for non-compliance, €100 per ton of CO2, approximately $10,800 per day of non-compliant operation. A vessel detained for ETS non-compliance earns zero revenue while costs continue. The IMO Carbon Intensity Indicator rates every vessel annually from A to E. Vessels rated D or E for 3 consecutive years face mandatory corrective action plans and potential class certificate restrictions. A vessel that cannot renew its class certificate cannot trade. A $22 million asset earning nothing and consuming $8,562 per day. A single compliance failure, a missed ETS surrender, a failed CII review resulting in port detention, can end commercial viability in a single enforcement action. What gets better at scale? A 10-vessel fleet spreads the fixed cost of technical management, naval architects, superintendents, purchasing staff, across multiple revenue-generating assets. Fuel purchasing power improves materially. Above 5 vessels, volume contracts with bunker suppliers generate $10 to $20 per ton discounts. On 10 vessels each burning 10,000 tons annually, a $15 discount saves $1.5 million per year. Period charter coverage across a fleet creates revenue stability that a single vessel operator cannot negotiate from the same position. What gets harder? Regulatory compliance scales in complexity faster than revenue. 10 vessels means 10 class certificates, 10 sets of annual audits, 10 CII ratings, and 10 ETS compliance accounts across multiple flag states. A single compliance failure generates the same enforcement consequences on one vessel, but now under scrutiny of regulators reviewing the full fleet history. Charterer credit risk scales with fleet size. A 10-vessel owner with long-term charter contracts secured from one charterer is exposed across the full fleet if that charterer defaults. Charterer default is not rare in shipping downturns. It is a recurrent feature of every cycle. At a certain size, this is a completely different business. A 20-vessel fleet is a financial holding company, a regulatory compliance organization, and a commodity trading operation that also moves cargo. Optimistic. Owner purchases a 10-year-old Panamax for $22 million, with $8 million equity and a $14 million loan at 7% over 10 years. Debt service $1,094 million. Charter rates average $17,000 per day across 340 operating days. Gross revenue, $5,780,000. Annual OPEX, $3,100,000. ETS compliance, $400,000. After debt service, net income negative $885,000. Even at above-average charter rates, the leveraged vessel loses money. Realistic. In year 2, charter rates average $13,500, consistent with 2025 annual averages. Main engine turbocharger failure causes 15 days off-hire and $380,000 in repairs. Port congestion at a Brazilian terminal adds 9 uncompensated waiting days. ETS cost rises to $520,000 following voyage rerouting that increased EU port calls. Revised gross revenue, $4,590,000. Unplanned costs and off-hire, $508,250. Revised net income after all costs and debt service, negative $2,763,250. The equity buffer of $8 million covers approximately 35 months of losses at this burn rate. The difference between those two scenarios is a charter rate, $3,500 lower, a turbocharger failure, and 9 days of port waiting. None of these are exotic disasters. All 3 happen to someone in this industry every week. The global dry bulk fleet has experienced 2 major crises in 20 years. 2008 through 2012, and 2014 through 2016. Both followed the same pattern: peak rate vessel orders, delivery into softening markets, charter rates below operating cost, leveraged owners forced into distressed sales or insolvency. The primary cause of failure was never poor seamanship or operational incompetence. It was entry leverage set against optimistic revenue projections without margin for cycle compression. 5 structural habits of survivors. No motivational language, only specifics. 1. They entered at low leverage or no leverage. A vessel earning $8,000 per day against $8,562 in OPEX, with no debt service, is generating cash. The same vessel with $2.35 million in annual debt service is burning $200,000 per month. The financing decision at acquisition determines whether the owner survives the trough. 2. They secured period time charter employment, multi-year contracts at rates covering OPEX and debt service, on a portion of the fleet before delivery. Period coverage at break-even rates is not profitable. It is the mechanism that keeps vessels operating through a down cycle while spot market peers are selling at a loss. 3. They maintained CII-compliant, ECA-compliant vessels ahead of regulatory deadlines. Charterers in 2026 select vessels with strong carbon ratings because their own supply chain sustainability commitments require documented emissions performance. A vessel rated D or E on CII is less employable and commands lower charter rates than a comparable vessel rated B. Employability is revenue. 4. They held 6 months of OPEX, approximately $1.56 million, in liquid accounts separate from vessel financing. Unplanned repair events require payment before the vessel is released from the shipyard. An owner without a repair reserve faces extended idle time or distress borrowing. Neither improves the P&L. 5. They monitored port state control records actively. Port state control inspections, regulatory boardings in every major commercial port, are publicly recorded on the Paris MOU and Tokyo MOU databases. A detention history reduces charter rate premiums relative to comparable vessels with clean records. Clean vessels earn more. Dirty records compound into commercial disadvantage that outlasts the original deficiency. The image is a Panamax loaded with iron ore crossing the South Atlantic at 12 knots. The reality is $8,562 in daily operating cost before fuel or port fees. A freight market that has declined 94% in a single cycle, and $546,000 in annual UETS compliance that no pre-2022 financial model included. Cargo ship ownership is not a business where the owner controls the price. Global commodity flows, geopolitical routing events, and regulatory agencies set the revenue. The owner controls only the cost.